Welcome back, everyone, to another episode of the Indy Investor Pod. So this is a podcast where we talk about anything and everything Indianapolis and real estate investing, tips and tricks, anything to help you out, provide some value. You can find it here on the show. So with that, let's get on with today's episode. What's up, everyone? Welcome to today's episode of the Indy Investor Pod. Today, I've got the wonderful Sterling White. Man, how you doing?
Welcome, everyone. Go ahead, strap in your seatbelts. We're going to take you along for the ride. You'll want to take notes. If you're swiping left on any apps that's out there, we're going to need your full attention. Absolute bombs and golden nuggets are going to be dropped.
Dude, I love your energy, by the way. Love it. So we'll keep that going the whole episode, so don't you worry. So today, I want to really dive in on kind of Sterling's adventure on commercial real estate, apartment buildings. He's kind of known in Indy for, you know, his famous neighborhood map that's been all over Bigger Pockets.
Okay, let's not go over the map.
yeah, but that's not what we're talking about today. We're talking about apartment buildings and multifamily. So I'm really excited about the episode because there's a lot of questions, at least with the people I talk to, about, you know, how to get started into it and kind of the ins and outs. And I honestly couldn't think of any better person than yourself for at least Indianapolis, the Indianapolis area, and kind of have you share your experience. So just starting out, Sterling, kind of give us a quick background of yourself, you know, and kind of explain how you wanted to get into this beast of commercial real estate and where you're at today.
Yeah, so I'll give everyone a Spark Note version, or I believe it's a Cliff Note version.
Yeah.
So born and raised here in Indianapolis in the not so good parts of the city, where when you're driving through it at the nighttime, you tend to roll your windows up and lock your doors. And fraternal twin brother, single mother, and just the environment we grew up in wasn't the greatest. Grew up on Section 8 housing, food stamps, and I'm sure of other government assistance she didn't tell us about. And I remember every other day in one of the complexes that we lived in was quote unquote called the projects. We had to get down on the ground because there were just stray bullets that were going on around. And fast forward, got started in real estate. This was 2009, where things were not going so well in the industry on construction. Shifted to single family home investing. And this was 2013, where I bought my very first deal, no money out of pocket, scaled up to 150 single families. And then in 2017, made the entire shift to multifamily. And my first deal was actually a 46 unit. So skipped from single families right to a 46 unit deal.
Wow.
And that's how I got my foot in the door.
Awesome, man. So let's just start right there. So you got a lot of single family units. Like why did you decide to say, hey, let's stop this strategy and let's get 46 units?
Well, I would say that many single families is quite intensive in terms of acquiring, because it wasn't 1, 2, or 3 buyers. It was close to about 120 to 130 separate transactions. So that was one thing, a huge volume, looking at a lot of deals. And then also that was very management intensive. So you've got 150 individual roofs scattered throughout, had different sides of Indianapolis, different sides of town, and then also owned several in Dayton, Ohio, and decided, hey, where do we want to where do we want to be long term? What model can we scale even more efficiently? And that's where multifamily just made the most sense.
All right. Yeah. So all your single family stuff, did you
Out of
liquidate?
those, no longer. Yep.
Okay.
Gone.
All right. Awesome.
I mean, they're still there, not gone, but yeah, no longer.
They're not under you anymore. So that's awesome. So 46 units. So do you have for yourself, I mean, what do you look for in an apartment building that you actually want to keep? Do you have a minimum number of units? Is there a reason why there's a minimum, or kind of tell me more about that?
Yeah, so at this moment, the minimum is 75 units. And that first 46 unit deal went full cycle on that. And the reason why 75 is the minimum is economies of scale, meaning that you're able to get an on-site manager as well as a full-time maintenance tech on site and be able to manage that. And the property can sustain it that way, versus the smaller you tend to go, it just doesn't make sense from a logistic and financial standpoint from a payroll side. So that's why 75 is the minimum in terms of the criteria.
Okay, awesome. That makes sense. So on our end, and kind of, you know, about us, like we'll offer to our buyers like the smaller buildings. When I'm talking, 8 units to 15 units. Like we haven't really had anything at a time where we're talking about 46 or 50 and above. So,
Not yet,
um,
maybe.
I get a lot of questions on my end when people are looking at the stuff that I'm selling. They're like, "Hey, Randy, I just don't know how to break this deal down." Like, because they think of it as a single family home or a quad, and I know the numbers are different. You got to look at them different ways. Um, so can we take some time? Like, can you break down, if you were to buy a property, it doesn't have to necessarily be 8 units, but if you're just going to underwrite an apartment building that maybe you're getting from a wholesaler or off market, like where do you start and how do you determine, yeah, this is a good deal? What are the key numbers you want to look at? And, what's that look like?
Yeah, so for myself in particular, I like to look at one, the debt service coverage ratio, to ensure that there's enough meat on the bone to one, cover the debt and then some. But the two really key indicators, what is the cash on cash return?
Okay.
Because there's going to, what is my actual cash that I have invested? What is going to be my return on that? And then also, what is going to be my internal rate of return when I exit in, let's say, 5 years? Normally it's done on a 3 to 5 years. Some people do it on a 5 to 7 year. And then IRR just simply takes into consideration, okay, over, let's say it's on a 5 year projection, that here's the cash flow I'm going to earn. Here is the sale in terms of the profit. And also it takes into consideration the time frame. So you know what your return is on a yearly basis. And that's how I look at it when analyzing a deal.
Okay. So, let's dive into it a little more. So if I send you a deal, like, are you typically, someone's going to run comps? Are you still doing the same thing right off the bat? Are you, are you trying to get an inspector in there ASAP? Um, like, really, like, let's dive into this and kind of take it step by step. So what's the first thing you do?
Yeah, so the first thing I do is a very preliminary underwriting to say, okay, I want to have the T12, which is the trailing 12 profit and loss, to understand how is the property currently operating? Where can I value add? Meaning, a normal C-class property is running about the operating expenses about 50 to 55%. However, if you receive the T12 and it's at, let's say, 70%, that's a good indication that there's value that can be created there. So that's one. And then also I received the rent roll to understand, okay, this is the current in-place rents through renovations. Let's say the property is outdated and the current rents are, let's say, $800 for a 2 bedroom. If I put in, what is it, a two-tone paint scheme, or I'll just keep it simple. If I turn this unit to market,
Hmm.
I'll be able to actually push these rents up to 1,000. So
Okay.
I'll run a model, okay, this is where it's currently operating, and then I'll run it when I put in these improvements, this is what it's going to look like. And then from there, I build out, okay, this is going to be my, return from the rental income. And then when I go to resell or refinance the property, this is going to be my overall return as well on an annual basis, including the rental income and then the profit from the sale.
Okay. And then when I know I mentioned like pulling comps, you said you still kind of do that stuff. So
And,
how is
and
how is that different?
Yeah, that I was just about to go into that. So when it comes to the multifamily side, and this was one thing I learned is versus with the single family, it's more of, okay, this property sold across the street from that for this. This property sold across the street for this. That's in very similar condition as mine, 3 bedroom, 1.5 bath,
Right.
detached garage. Versus with the multifamily, it's looked at on a cap rate basis, meaning the NOI. If you drive up the NOI, and from that is, let's say properties are trading between a 5 to a 7 cap, that is how you would determine the value of your asset. So that means is, let's say I'm gonna just do some quick math right here. Your NOI in 5 years is $300,000.
Hmm.
So you would take that divided by 0.05, and that will give you your value of $6 million as the
Okay.
purchase price. So
Okay.
that's how you would look at in terms of analyzing is, okay, I buy it for $3 million. I drive up the income to $300,000. I'm invested into it $4 million. In 5 years, I expect to exit at a 5 cap, and that's the value, $6 million.
Okay. Yeah, that makes sense. Now, is it necessarily a bad thing to have the only building in the area? So if you're in an area that's surrounded by just tons of single family or just small like duplexes, things like that, and then you've got a big, let's just say 25 unit building, is that a bad thing? Is that okay? How should you look at that?
So I would look at it from the standpoint of when you go into a deal, even though when you're a buy and hold investor, still take into consideration an exit strategy. So you have to consider what is the buyer going to look at. In that circumstance, you're limiting your buyer pool, meaning that you wouldn't be able to have as many buyers coming in because there could not be as much in terms of it would just be difficult in essence to be able to determine a value of your property. You'd
Right.
have to go further out, and then that's when you're still just you. So let's say that your properties that are further out are trading at a 7 cap on yours, instead of saying, even though it's more desirable location, I feel it's a more desirable, let me be more conservative and say on an exit is actually going to trade at an 8 cap. So that's one thing, all the different factors. I'd be concerned if there wasn't as much multifamily around though.
Yeah, I mean, the way I look at it is because I know areas that are kind of like that where there's like a building just comes out of nowhere, and it looks like it'd be a great building to hold on to and be good for the right buyer. But then you look around and you're like, man, I can't find anything like this around. I have to go all the way on the other side of town.
It could be a good thing. It could be a bad thing.
Yeah,
Yeah.
so that it always it matters about your analysis and the numbers, right?
Yeah. Meaning, I saw some broker send over a deal that was in Broad Ripple, or it wasn't Broad Ripple proper, which is for those of you guys that are on here, which is very desirable location. And they were trying to pull comps that were from the South Side, in Greenwood and
Yeah,
different, what is it, Fountain Square, Carmel. I was like, that's not even, because they couldn't
yeah,
find comps that were very similar. And in that case, it's very hard to determine what your exit is from that.
yeah, yeah. Totally agree there. So moving forward, I kind of like on this on the analysis of a deal. So you've already kind of ran your preliminary numbers based on your caps and all that stuff. You're taking the next step. So do you initially go into getting that property inspected, or like when do you take that step? You say, okay, let me put this under purchase agreement because I've got enough information to then move forward and get your financing in place and things like that. Like when does that part happen for you?
Yeah. So one thing I also have to mention with my model, I do a syndication. So it's just not money. I bring on investor partners as well. That's one thing. And when doing the preliminary underwriting, and let's say we're within range of purchase price, so we'll do assumptions and say, okay, based upon this property, we know we're going to have to turn all the units, which is going to be average 7,500. And then
Mhm.
we look at the remainder of, let's say, the roof, let's say all the windows. So we'll put an assumption on cost on that. And then the owner, in that case, they agree. We send a LOI, which is a letter of intent. And then from there, they agree to those terms. And then we draft up a full PSA, which is a purchase agreement. Then we go to contract. And then that's when there's a slew of different things. We have an inspector come out. We have a phase one that needs to be done by the lender. We visit the property to walk all the units. We do a lease audit. I mean, there's tons that go into the due diligence, but this is why it's important, you guys, to have a team that's
Yeah.
involved.
Yeah, absolutely. And then you mentioned syndication, so that was kind of one of my topics I want to talk to you about. And I know what it is, but for someone who maybe is listening for the first time, they're looking to get into something like this. Briefly, very briefly, just kind of explain what syndication is, and then also let's talk about when is that necessary? Is there a certain point where it makes sense and it doesn't make sense? Kind of explain that.
Yeah, I would say it really, in terms of making sense and not making sense, depends on where someone is looking to go. And in essence, a syndication is just uh, pulling together investor funds to
Mhm.
be able to take down or acquire a project, such as a 46 unit deal or 25 unit deal. And why it would make sense for, and why it determines case upon case, is the ability to scale. So if you use your own cash, let's say I purchased a deal with the here in Indianapolis. I didn't have $837,000 just sitting around to be able to put down as
Right.
down payment on the 80 unit that was here.
Yeah.
So one, I could have taken my however long to be able to get that income to then do that, which I mean that deal would have traded so many times, possibly between that point. Or I can go out and be of value to others. They invest alongside me, and I give them a piece of the equity and have their money make money with their money. So it's the way to ultimately scale.
Okay. Yeah, and that makes sense to me. So, when you're kind of building that syndication group, how is that process? Is it, I mean, how long did it take you to get to the point where you had enough people kind of pooling in and taking down that first deal with you?
So it took 6 years. And that's one thing I want to mention to people is it's, of course, you see the highlights. Oh, he took down the 46 unit deal. There was a lot that went behind that and all the single families in terms of the trials, tribulations, the successes that ultimately led up to that deal. And then also had to look through a ton of deals as well to make that transition to that first one. But in essence is, I forgot the question, Randy. What was the question? Oh, the team determining what you're good at, your strengths, and then finding people to put into place in terms of the weaknesses. Myself is I'm a deal junkie. I enjoy finding the deal and then actually being the marketer, going out and finding the investors, putting myself out there, and then the investors come in. But when it comes to the underwriting, building out a entire performer, underwriting is an art when it comes to syndication and the multifamily side. And when it comes to the property management, that's not something I enjoy so much. So ended up getting people in place to ultimately to be in those right positions to where I can focus on my strengths and what I'm good at, and then have them in their strengths and what they're good at, but are ultimately complementing my weaknesses.
Okay. Yeah, that makes sense. Now, how about working with banks? So, I guess what's your experience with working with banks, getting some loans on these for the acquisition side of things? And I mean, I've talked to a couple of people that kind of do what you do in different states, and they say I've heard different things about like requirements on getting approved, and sometimes like they don't really necessarily look at your personal credit. It's all like your business side. So
They do, but it's not.
it's not the same as if you're getting, a traditional mortgage, right?
Or a car or something where
Or a
they
car. Yeah.
heavily look at, yeah, something along those, yeah.
So, like as far as working with banks for financing, let's talk about that a little bit. What's that like as far as someone like myself and a group of maybe four other partners wanted to get a loan from the bank? Like, what would that look like?
Yeah, I would say is if you can go through the agency, and agency is like the Freddie, the Freddies and the the Fannie Mae's, is there's a Freddie Mac small balance loan, so they have the most attractive in terms of financing. However, I went that route. Both my partner and I, who I own apartments with, is we went that route, and it is, especially getting into it, it can be difficult. And I still have not closed a deal from them just yet. Had two deals where they just pulled the rug right underneath. So ended up going with the regional bank, in which it's a lot smaller. You're not dealing with multiple spider webs in terms of this person that's speaking to another person that's speaking to another person that's speaking to the decision maker. So at this point in time, it hasn't been difficult getting loans from a regional bank standpoint because we formed a relationship. We met the liquidity as well as the net worth, and the deals that we were buying did good in terms of debt service coverage ratio,
Hmm.
and they also knew the locations, and they looked more at the asset. They looked at us as operators, so a mix of good operators and also a good asset in itself. Then it was a no-brainer from their side.
Okay. And how long of a process should that take for you buying 70 units? Like what's the period from with working with a bank? Like how long should that timeline be?
75 to 90 days.
So that's pretty normal.
Yeah, that's pretty typical. And the it yeah, if you already have that relationship with, and that's one thing I would tell people is to start the relationship with the bank you already have a relationship with. Hopefully it's not a larger bank like a Chase or a
Yeah.
PNC. If it's a smaller one and you get that relationship, that's so much better, like a smaller credit union, some
Mhm.
people, or even local banks. And then from there is, especially into, well, I wouldn't say where we're at right now in COVID, but lenders, people realize how much of a safe investment, you could say, quote unquote, safe investment, or less risky in terms of multifamily. So lenders are even more aggressive to deploy into those.
Okay. Yeah. So it sounds like the same thing goes with the residential single family side. It's always best to work with those local smaller banks. I always try to steer, clear of like Chase and stuff. Sorry if anyone's from Chase listening to this, but it's just the truth. Step your game up. But yeah, it sounds like the same thing, just a little different as far as the deal goes. So yeah, I definitely agree with that. So what is so with everything happening with COVID right now, like what do you see? Is there I know it's the residential side is different than the commercial side. Is there a shift coming for that kind of space, or is just because of everything that's happened, or is that not really a thing? Or
Uh, it's one of those things that we're going to have to see. No one, it's very uncertain times. What I've seen as an operator, I have a 80 unit and 156 unit that's here in Indianapolis. The collections has been phenomenal. And I would say in terms of, it seems from pre-COVID, it's just a month's very similar, maybe a small little tiny drop, but nothing that's alarming.
okay,
So from that standpoint, it would be market upon market, because some other settings, I believe New York, California, got really hit hard. So I believe those deals will start to as we come out of the forbearance and
yeah,
those types of things, that those will start to come up as really good opportunities. But some other markets where collections has been strong, that the cap rates still are going to things will the owner's expectations. I feel that, was I going to go with that? It in a market like Indianapolis, I believe the prices really aren't going to be affected too much from what they firmly were.
yeah, yeah. So overall, Indianapolis has always been known for that type of market. We
Yeah,
take a soft blow when there's a big crisis going on. So that's why people love it, right?
yeah, very
Um,
stable,
so
and yeah,
I
it's
know.
not huge swings.
Right, right. So I know your team's like in the trenches looking for these deals all day long. So kind of piggybacking off that topic, are you seeing a little bit more opportunity to pick up deals right now, or do you think it's still going to be like a waiting game to see how everything kind of plays out? Because I know on
Right.
our end for just the residential side, we've been kind of seeing a little uptick. The last couple months, obviously, were weird for everyone, but now we're seeing, or we're able to acquire properties kind of on the normal number per units on a month. So, like, are you seeing more opportunity for your team to, acquire some more apartment buildings, or how's that look?
Not at this moment. I feel when we were really in the midst of the COVID ordeal, we had more of a success because we go direct to owner and we start with cold calls. So we had good success in terms of getting directly in touch with the decision maker, because most of them were actually just sitting at home. So that was one good thing from that standpoint. They weren't as busy, but in terms of their expectations were still pretty high in terms of what we were looking to buy it for, and what they actually wanted to sell it for was just a huge gap. So that's why I feel the expectations are still uh, sellers are still high, and there's going to have to be either buyers are going to have to come up or sellers are going to have to come down, or there's just going to be a moment in time where there's just not going to be very little to minimum in terms of transactions that are being made. So I haven't seen much of a difference just yet on the acquisition.
All right, all right, that's interesting. So, so if you were to start over again, let's just say you're like brand new into this, and you just had your blinders on multifamily apartment buildings, would you encourage someone to I guess build the team and just go, I would call it a home run and get a 50 unit? Or would you still be okay with going out and buying like a 10 unit building and slowly kind of learning the ropes and scaling up? What would you do?
Yeah, and this is one question I get often asked in a different direction, a different type of context. But if I were to go do it all over again, I would still start with single family, because
Okay.
one, lower barrier to entry. That's how I was able to get my foot in the door, snowballed. Because one thing some people may experience, which many people don't talk about, someone gets into the industry, they buy that 50 unit, and they've taken all this time to build up to that, and they decide, I don't even want to do this. This isn't even a good fit. So
Yeah.
that's one thing is just for me is getting your foot in the door. If you could do a single family house, if you could do a 5 unit, 10 unit, something similar to that, or even go start that, and then you start to get the snowball effect, then you can gradually build up. However, the flip side of that, and I'm pulling from two separate ends, if you
No,
can go
go. Yeah, I love
larger,
it.
if you can go larger from the get-go, that's even better because you're able to get those economies of scale and things even more efficient. And so, yeah, if you can go bigger, that's better because it's one transaction, one buyer, multiple units in one location. So I'm definitely pulling from both ends, but I don't want someone to be uh, run into analysis paralysis. Man, I want to go bigger
Yeah.
because you get that economy, and they never end up taking action.
Yeah. No, I hear both sides as well. So I'll talk to new investors, you know, they haven't bought anything yet. So I'll ask them, like, what are you looking for? No, I want a 40 unit. I want a 25 unit right off the gun. And I'm like, that's very ambitious, but at the
But
same time, like who am I to hold you, like try to talk you out of that?
exactly.
So yeah, I've heard kind of both ways, like learn the ropes, work your way up from single family, and then maybe get a quad and then kind of go up from there. Then I've heard some people just, you know, they focus on the big stuff only and they don't want the single family holding them back from what their path. So I was just curious to see your insight on that. So, last thing here, with as far as like your multifamily, what's your exit strategy for like the units you have now? Kind of what's your long-term goal? Where do you want to see your business kind of take off to and flourish at?
Yeah, I would say steadily just buy and hold. That's always been the philosophy in terms of just holding on to it for the long term. In 5 years, refinance the cash, provide it back to the investors, and they still retain equity and ownership. So they're earning money infinite because they have nothing in it, and just to hold on to it for the long term. So that's the main premise on the buy and hold with the current holdings. And then future is just one of my goals that I have is just owning over 3,000 units across the Midwest. But
Okay.
ultimately, my huge why is why I'm doing this is just want to be a message to the people who came or in the or either or in the environment that I'm in that, hey, you don't have to take this path. Here's a path that I took, and this is the roadmap ultimately because there is a way out. And it's hard when you're in that environment because to not realize that there is a way out of it because what you're surrounded by. So that's why I want to be
Okay.
that idea for those individuals to just pull them out and say, hey, I came from exactly where you came from, and this is what I was able to accomplish.
I love it, man. Yeah, I love that vision you have. So, you know, good luck with everything on that. So we're kind of wrapping up towards the end of the show. What's I guess your last piece of advice regarding multifamily investing, commercial real estate? What would you give anyone that you could think of, like any advice right now, for any newbies or experienced investors?
Yeah, I would say starting with their mindset, huge on that. And when I'm a firm believer, when I made the shift from single family to multifamily, is looking at it as the 80-20 principle, Pareto's law, meaning, let's say, I'll use an analogy, the English language. When you look at a dictionary, and there's multiple dictionaries for the English language, it's huge in terms of words, but you think of on a day-to-day basis in our years or lives experience, we only use 15 to 20% of that. So I use that same principle with when I made the transition to multifamily was there's a lot of things to know and I'm still always learning. So understanding what is that 15 or 20% that I need to know to really get the ball rolling. So knowing that, understanding you just need to know that 20% and then start taking action and then setting myself a deadline. Hey, 60 days, I'm going to do all the necessary education to understand that 20%. What is the net operating income? What is cap rates? What does that mean when speaking with the broker? Understanding the specific lingo. And then from there is you just got to take action because there's just going to be so much that you learn in the industry that no book or forums that you could have gone on would have taught you.
Awesome. Yeah. And it's funny you said no book. My last thing was, do you recommend any books?
No books,
Okay.
zero books, everyone, zero.
All right, brother. Well, I really
Oh,
appreciate it.
I was there. There is one book that really did help me on my journey, which was Multifamily Millions by David Lindhall.
Okay.
And that was just a good fundamental. And it was one of those, because what I've ran into with real estate books, most of them tend to be very mundane and dry. That was
Hmm.
one really good one that got my, in terms of a knowledge standpoint. And then also being on biggerpockets.com, which if you guys are on there, it's completely free resource,
Yeah.
is that you can actually, I myself, post actual deals that I've completed as case studies. This is how it was found. This is how it was negotiated. These were the terms with the investor partners. These were the lessons that were learned. A slew of knowledge, because I'm a firm believer. Yes, it's good to learn from your own mistakes, but it's even better to learn from others' mistakes.
Yeah, awesome, man. Well, I know 30 minutes goes by quick, so that's as much as we could talk multifamily in 30 minutes. I hope you took Sterling's advice and took some notes, because he definitely dropped some good knowledge today and good tips for anyone looking to get into this space. So real quick, Sterling, if anyone wants to follow you on social media, where can they find you?
Yeah, at Sterling White Official. One more time, that is at Sterling White Official.
Awesome. Well, I appreciate it, Sterling. Thank you for being on the show today. And everyone listening, we'll see you on the next episode.
Awesome. Keep being awesome, you guys.